Hello everybody. Today I'll be presenting on the topic changes in ITR forms and its applicability for assessment year 2025-26. So let's dive in. The first change is removal of Aadhaar enrollment ID. Now previously whenever you used to file your ITR, you were allowed to use your Aadhaar enrollment ID for it. But now they have strictly removed it. What does that mean? So you should have a valid Aadhaar card, a 12-digit Aadhaar number which will be used by you while filing your ITR. That means Aadhaar enrollment ID is a no-go for you now. This also brings the compliance part into picture. What is that? Your Aadhaar and PAN must be linked. So that is one of the changes for this assessment year. The next change is simplified reporting for long-term capital gains. Now, previously, whenever you used to have long-term capital gains under section 112A, you were supposed to file ITR 2 or ITR 3. That means ITR 1 and ITR 4 was blocked for you. ITR 1 is for individuals who are salaried, have one house property and no other foreign income or business income. ITR 4 is for people having presumptive business income. Now, any amount of capital gain would make you liable to file ITR 2 or ITR 3. And ITR 2 and ITR 3 is very complex compared to ITR 1 and ITR 4. Now, the change brought in is if your LTCG under section 112A is up to rupees 1.25 lakhs, that is the new change that is brought in the capital gain rule. The exemption has been increased to 1.25 lakhs. So, if your LTCG is within rupees 1.25 lakhs, you can file ITR 1 or ITR 4 provided you satisfy other conditions. The one additional condition that you need to satisfy is there should be no brought forward capital loss. That is, there should be no capital loss in the previous year that you would like to set off this year. So, if you are having only LTCG under section 112A up to rupees 1.25 lakhs and no other capital gains, you can file ITR 1 or ITR 4. The next change is mandatory disclosure of disability certificate acknowledgement. Now, section 80DD and section 80U is for deductions which is in relation to disability. Now, section 80DD is when you incur expenses for a dependent disabled, not just disabled, a dependent disabled. So, if you incur expenses for a dependent disabled, you can claim deduction under section 80DD. Now, if you yourself are disabled, then you can claim exemption for the deduction for the expenses incurred by yourself for your disability under section 80U. These two sections were misused quite often. So, the change brought in is now you need to mandatorily quote your disability certificate acknowledgement number, without which you cannot claim deduction under section 80DD or section 80U. Now, this increases your compliance burden, but it ensures that there is no wrongdoing in this section. The next change is mandatory disclosure of all bank accounts. This is one of the major changes brought in. Previously, you were not supposed to declare all the bank accounts that you had. You were supposed to declare very few. But then the change brought in is such that you need to declare all your active bank accounts, not bank accounts, all the active bank accounts. So if you are having a dormant account or inactive account or inoperative account, you need not declare it. Now, what is a dormant account? A dormant account is an account in which there have been no transactions in the past 2 years. Now, there could be transactions like bank charges, interest charging in your bank account. Those are the normal transactions that need to take place irrespective of whether your account is active or not. So, apart from that, if there is any transaction in the past 2 years, then it will not be considered as a dormant account and it will be an active account which you need to declare. So, you have to declare all your active accounts from this assessment year onwards. The next change is new regime opt-out disclosure and confirmation. Previously, not from the recent assessment years, but long back you had to opt out of the old tax regime and opt into the new tax regime, for which you had to file a form. Recently this change was brought in. This is not specific to this assessment year, but this is a change that you need to keep in mind. When you opt out, you mean opting out of the new tax regime and opting into the old tax regime. Now, what does that mean? Previously, old tax regime was default. Now, new tax regime is default. So, when you are opting out of the new tax regime. Keep in mind. So, if you want to file your return under the old tax regime, then you need to file Form 10 IEA. If you want to file it under the new tax regime, no such form needs to be filed. Also, you need to provide a confirmation if Form 10 IAA was filed for previous years as well, in case there was opting out involved. The next change is asset and liability reporting threshold raised. This is again a significant change brought in by the income tax department. Previously, if your gross total income was more than 50 lakhs, that is, if it was 50 lakh 1 rupee, you would have to disclose all your assets and liabilities. But the threshold for this year is rupees 1 crore. So this is a major relief, a welcome move for all the taxpayers having in gross total income up to rupees 1 crore. So what does this do? If your income is 99 lakhs, you still don't have to declare your assets and liabilities. The moment your income crosses the 1 crore limit, that is 1 crore 1 rupee onwards, you will have to disclose all your assets and liabilities. This is a satisfactory move for the taxpayers, and this reduces the burden on the income tax department, and they will be able to concentrate much more on the high net worth individuals. The next change is introduction of ITRU, that is updated return. Previously, updated return could be filed only within 2 years from the end of the relevant assessment year. So if your assessment year was say 2020-21, you could file ITRU only for the next 2 assessment years, that is 21-22 and 22-23. But now you can file it within the 4 years from the end of the relevant assessment year. So what does that mean? If you couldn't file your ITR for assessment year 2020-21, you can file the ITR in assessment year 21-22, 22-23, 23-24 and 24-25. This is the change brought in, and to include this change, a new ITRU has been brought in, but as of now it's still not into effect, but the change is definitely brought in. Now this is an interesting change, buyback proceeds taxation. Now when you look at the point of view of a share of a person having shares, if shares go out of his demat account, it means he has sold the shares, so logically it is a capital gain. But in case of buyback, what happens? There is a company say A and there is a person say B. B is having shares in the A company. Now A company says, I will buy back your shares. So this person gives his shares to the company, and the company in return gives money to the shareholder, that is person B, from its profits or reserves. Now this might seem familiar to you. Whenever a company gives out money out of its profits or reserves, it is like a dividend. So in this case, although for the person having the shares it seems like a capital gain, from a bird's eye view it is almost like the company is paying out dividend to that shareholder. And this is the change brought in for this assessment year. The buyback proceeds will be treated as deemed dividend. So it is not exactly a dividend, but we will tell it is a dividend. What does that mean now? That means you won't be able to declare that income under capital gain. There won't be special rates applicable to it. The income will be treated as other income. Why? Because dividend is other income, so it will come under the head of other income. Now in case your slab rate crosses the limit and you are liable for 30% tax rate, this is a bad move by the income tax department for you. Why? Because you will have to pay higher tax. In case special rates were applicable, you would have to pay just 12.5%, 15%, whatever the rate is, the special rate, you would have to pay that. But now you need to pay higher tax. Now keep in mind, although you are declaring the income under income from other sources, under the head capital gain, the cost of share you will have to mention. Why? Because shares come under capital gain, right? So in capital gain you have to show the cost of shares, but the sale proceeds, that will be zero. Why zero? Because the sale proceeds, the income will be shown under other income. So sale proceeds under capital gain will be zero, but there will be some cost. For example, X amount. So when you reduce some amount from zero, it is negative. That means it is capital loss. So minus X will be your capital loss, and this can be set off against other capital gains, and can be carried forward as well for the next 8 assessment years, just the way how we normally do it. Now capital gains segregation by transaction date. Most of you might be aware that capital gain rates have been changed and certain exemptions have also been changed. Now this change is effective from July 23, 2024. So previously capital gain rates were, for example, 10% above 1 lakh, 20%, 15%, those were the rates. But that will be the rate applicable only if it is before July 23, 2024, the capital gain. If it is on or after July 23, 2024, the capital gain rates will be 12.5%, and the new rates, whatever the rate is applicable as per the new Finance Act. Now, in the ITR form, this bifurcation is provided. Why is this bifurcation provided? Because the income tax department should know very well when this capital gain was incurred and what rate should be applicable on it. Now, one thing to note here is it is not applicable in ITR 1 or ITR 4. Why? Because even though you are declaring capital gain in ITR 1 or ITR 4, there will be no tax on it. Why? Because it is up to 1.25 lakhs rate. So there will be no capital gain, and doesn't make sense to provide bifurcation. So 1.25 lakh limit holds, but bifurcation is not required there. So this will be applicable in other ITR forms, ITR 2, ITR 3, etc. Now, new section for cruise shipping business. This is the presumptive income brought in for cruise shipping business. The income must be earned by non-residents. So, in case you are a non-resident having cruise shipping business income, a new section is brought in for you for presumptive income taxation. That is section 44 BBC. I won't dive deep into it, but this is the change that you need to keep in mind. In case it is applicable, you need to go through this section for knowing how to declare your income, how to compute your income and stuff. That is it from my end. These are the changes relevant for the assessment year 2025-26, the changes in the ITR forms. Thank you. So these were the changes applicable for the ITR forms from financial year, 2025-26. Ayyo, wrong I thought. So these were the changes applicable in the ITR forms for assessment year 2025-26. Thank you.